Credit can be an amazing tool. It can get you into your dream home or even send your child off to college. It all does come at a cost, however, and some banks may call it the cost of doing business. But for this presentation, I'd like for you to reference it as the cost of credit. And there are a few terms that I would like to get you familiar with as you consider using credit. And first is fees. Fees, these are charges a financial institution may make for an application processing or even for servicing your credit request. A servicing fee may be identified as an annual fee by a lender. Interest, this is typically defined as a percentage and is ultimately the amount of money a financial institution will charge you for allowing you to borrow. This can be fixed or variable in a defined percentage. APR, or annual percentage rate, is defined as the cost of borrowing money on an annual basis and will include the interest rate plus fees. Minimum payment, or paying the minimum, is the required remittance to reimburse the financial institution for the credit issued. In most instances, borrowers will find that paying the minimum is not the most cost-effective way to borrow. In the scenario that you're seeing on screen, we have a borrower that has used $10,000 worth of issued credit at 15% APR with a minimum payment of 4%. With the borrower paying the minimum payment of $400, in this scenario, it takes the borrower 12 years and 4 months, paying close to $4,500, almost half of what they originally borrowed. Where if that same borrower had added an additional $250 to their payment monthly, the credit issued is repaid in 15 months with nearly a fifth of the interest charged in comparison. And that's what you're seeing in these two scenarios on screen.